Welcome to Christine's Finance and Investment channel. Are you thinking about investing in ETFs, but worried about the market being at an all-time high? It's a common concern. Nobody wants to buy at the top and watch their investment plummet, but it doesn't have to be a gamble. By understanding the dynamics of the market and following some smart investing principles, you can make informed decisions. We'll break down the factors you need to consider and provide you with actionable tips to help you invest with confidence. Remember, investing is a marathon, not a sprint. Before you hit that buy button, it's crucial to understand both the potential rewards and risks involved with investing at historic highs. While past market performance is not a guarantee of future results, history has shown that over the long term, the stock market tends to go up. We'll delve into the concept of time in the market versus timing the market, and why trying to predict short-term market movements is often a fool's errand. We'll also explore strategies like dollar-cost averaging that can help you mitigate risk and potentially lower your average cost per share. By the end of this video, you'll have a clearer understanding of whether investing in ETFs at historic highs is the right move for you. When considering investments, it's easy to get caught up in the day-to-day fluctuations of the market. However, it's crucial to step back and look at the bigger picture. Historically, over the long term, the stock market has consistently trended upwards. This upward trajectory is driven by numerous factors, including technological advancements, population growth, and overall economic expansion. It's important to remember that investing is not about trying to perfectly time the market, but rather about participating in its overall growth over time. One of the most powerful forces in investing is the concept of compounding returns, often referred to as the eighth wonder of the world. Compounding is the snowball effect of earning returns on your initial investment, as well as any previous returns. The longer your money is invested, the more time it has to compound and grow exponentially. The earlier you start, the more years your investments have to benefit from the magic of compounding. Remember, time is your greatest ally in investing. Investing in the stock market is a journey, not a destination. There will be ups and downs, periods of exhilaration, and moments of doubt. The key is to stay focused on your long-term goals and not get sidetracked by short-term market noise. Instead of fearing these dips, view them as potential buying opportunities. By maintaining a long-term perspective and sticking to your investment plan, you can ride out the inevitable waves of the market and come out ahead in the long run. One of the most effective strategies for navigating market highs and lows is dollar-cost averaging, often shortened to DCA. This investment approach involves investing a fixed amount of money at regular intervals, regardless of the market's current price. By investing consistently, you essentially average out your purchase price over time. This is particularly beneficial during periods of market volatility. DCA takes the pressure off trying to time the market perfectly, which, as we've discussed, is a difficult endeavor even for seasoned investors. One of the biggest advantages of dollar-cost averaging is that it instills discipline in your investment strategy. DCA helps you stay the course and avoid emotional reactions to market swings. By automating your investments, you're less likely to let fear or greed dictate your actions. This disciplined approach can be particularly helpful for long-term investors. Remember, investing success is often more about consistency and patience than it is about trying to time the market perfectly. Market volatility is a fact of life for investors. Dollar-cost averaging provides a way to navigate this volatility without constantly trying to outguess the market. By spreading out your investments over time, you're reducing your exposure to the risk of investing a large sum at precisely the wrong moment. If you're using DCA, you're buying fewer shares at the peak and more shares when the market dips, potentially mitigating your losses and smoothing out your investment journey. DCA acts as a buffer against market swings, helping you stay invested and on track to reach your financial goals. Market timing, the elusive art of buying low and selling high, has captivated investors for generations. However, the reality is far more challenging. Countless studies and decades of market history have consistently shown that accurately predicting market movements, especially in the short term, is incredibly difficult, even for seasoned professionals. The stock market is influenced by a myriad of factors, from economic data and geopolitical events to investor sentiment and technological advancements. While some investors may get lucky with a well-timed trade here or there, consistently timing the market over the long run is an exceptionally rare feat. The desire to wait for a market dip before investing is understandable. However, this wait-and-see approach can come at a cost, often referred to as the opportunity cost of investing. While you're sitting on the sidelines waiting for the perfect entry point, the market may continue to climb, potentially leaving you behind and eroding your purchasing power. By delaying your investment in anticipation of a market correction, you're potentially missing out on valuable time for your money to compound and generate returns. This lost time can significantly impact your long-term investment outcomes, especially when considering the erosive effects of inflation. Inflation, the gradual increase in the prices of goods and services over time, is a silent but potent force that can erode the value of your money. When inflation is high, your money buys less over time. While waiting for a market dip might seem like a safe strategy, you're essentially losing money to inflation if your cash is not invested and growing at a rate that outpaces the rising cost of living. Investing in assets like stocks or ETFs, while not without risk, has historically provided a hedge against inflation. By investing in the stock market, you're essentially putting your money to work, giving it the opportunity to grow and maintain its purchasing power over time. When it comes to investing, diversification is your best friend, and ETFs or exchange-traded funds offer a fantastic way to diversify your investment portfolio. Instead of buying individual stocks, which can be risky, ETFs allow you to invest in a basket of assets. By investing in an ETF, you're essentially spreading your risk across multiple companies or assets. This diversification helps to cushion your portfolio from the ups and downs of individual stocks, providing a smoother ride for your investment journey. ETFs come in all shapes and sizes, offering investors a wide range of investment opportunities. You can find ETFs that focus on specific sectors, like renewable energy or artificial intelligence, allowing you to tailor your investments to your interests and market outlook. There are also ETFs that track bonds, commodities, real estate, and even international markets, providing you with global diversification. This wide array of options allows you to create a diversified portfolio that aligns with your risk tolerance and investment goals. Remember, ETFs offer a convenient and cost-effective way to access a diversified basket of assets, making them a valuable tool for investors of all levels. Just like a ship at sea needs a strong hull and a skilled captain to navigate stormy weather, your investment portfolio needs diversification to weather market storms. Market downturns are inevitable, but a well-diversified portfolio can help mitigate losses and keep you on course toward your financial goals. When one asset class or market sector is struggling, others may be performing well, helping to balance out your overall returns. By spreading your risk across different asset classes and geographic regions, you're essentially building a more resilient portfolio that can withstand market shocks and deliver smoother returns over the long term. Remember, diversification is like an insurance policy for your investments, helping to protect your hard-earned money from the unexpected. Investing without a plan is like setting sail without a destination in mind. Before you invest a single dollar, especially in something like ETFs at historic highs, it's crucial to establish clear financial goals. What are you saving for? Retirement? A down payment on a house? Your children's education? Your investment goals will shape your investment strategy and determine your time horizon for investing. Once you have a destination in mind, you can chart your course by creating a long-term investment plan. This plan should outline your investment goals, risk tolerance, time horizon, and asset allocation strategy. Your risk tolerance refers to how comfortable you are with the ups and downs of the market. Imagine a seesaw perfectly balanced with equal weight on both sides. Now imagine one side gradually getting heavier, throwing the seesaw off balance. This is similar to what can happen to your investment portfolio over time. Rebalancing is the process of periodically adjusting your portfolio to maintain your desired asset allocation. Rebalancing helps to ensure that your portfolio remains aligned with your risk tolerance and investment goals, preventing any one asset class from becoming too dominant. Investing can be a bit like navigating a ship through treacherous waters. There will be storms, calm seas, and tempting sirens along the way. The key to reaching your destination safely is to stay focused on your course and resist the urge to react impulsively to every wave or gust of wind. In the world of investing, these distractions often come in the form of market noise, emotional reactions, and the allure of quick profits. Market noise refers to the constant barrage of news, opinions, and predictions about the stock market. It's important to remember that not all market noise is created equal. Section 4. The long game, patience and perspective. Investing is a marathon, not a sprint. Make strategic decisions that align with your long-term goals. Focus on time in the market, not timing the market. The longer your money is invested, the more it grows and compounds. Taming the emotional roller coaster. Investing can be an emotional roller coaster. It's natural to feel excitement, apprehension, and fear. You see potential gains, but worry about downturns. Prevent emotions from hijacking your decisions. Invest with logic, strategy, and a long-term perspective. Fear and greed are two powerful emotions that can wreak havoc on your investment portfolio. Fear can paralyze you, preventing you from taking calculated risks. Greed can lead to overconfidence and excessive risk-taking. Acknowledge these emotions and develop strategies to mitigate their influence. Remind yourself of your long-term investment plan and the reasons behind your choices. So how do you keep a cool head when the stock market feels like a casino on overdrive? Start by tuning out the noise. Limit your exposure to financial news and social media hype, which often amplifies emotional reactions and promotes short-term thinking. Remember, the constant barrage of market commentary is designed to generate clicks and views, not necessarily to provide sound investment advice. Instead of obsessively checking your portfolio every day, focus on the long-term fundamentals of your investments. Are the companies you're invested in still performing well? Has your investment thesis changed? If not, there's no need to panic over short-term fluctuations. Another helpful strategy is to seek guidance from a trusted financial advisor. A good advisor can provide objective advice, help you stay disciplined, and talk you off the ledge when emotions run high. Section 4. The power of perspective. Zooming out for clarity. When the market hits new highs, it's easy to get caught up in the excitement. Investing is a marathon, not a sprint. There will be ups and downs, periods of exhilaration and doubt. Maintain a long-term perspective and avoid short-term noise. Zoom out and look at historical performance. Despite recessions and crises, the market trends upwards long-term. Past performance isn't a guarantee, but it shows recovery and growth. Embracing market realities. We've covered a lot of ground, haven't we? From market timing to dollar cost averaging and the importance of a sound investment plan, we've explored the stock market's essential elements. Remember, investing at historic highs isn't inherently good or bad. It's about understanding market dynamics and managing risk. Section 2. A prudent approach, navigating historic highs with confidence. Should you invest in ETFs at historic highs? It depends. Long-term investors with a diversified portfolio can benefit. Approach with prudence and realism. Avoid FOMO. Revisit your plan and assess risk. Consider dollar cost averaging. Seek guidance from a trusted advisor. Section 3. Your financial journey. Investing with purpose. Investing is more than just a means to an end. It's a journey of financial empowerment. Take ownership of your financial well-being. Save for retirement, a home, or education. Investing helps achieve your goals. Educate yourself, understand risks, and seek guidance. Start today, even with a small amount. Watch your wealth grow over time.